Good afternoon, ladies and gentlemen, and welcome to this MEDays Investment Summit. This session focuses on one of the most decisive forces shaping Africa's economic trajectory, fintech and digital transformation. Across the continent, technology is defining access to credit, how value moves across borders, how governments design policy, how researchers bring innovation to market, and how citizens build trust in digital systems. Africa is not merely adapting to global trends. Africa is shaping them. Today, we are joined by an exceptional group of panelists, innovators, investors, policymakers, technologists, and thought leaders who represent every layer of this transformation. So before we begin, it's my honor to introduce you to our group of panelists. And today, I'm privileged to have with me Mr. Andre Ayoti. He's director of K-Power investment firm, Deep Tech in Africa. Mr. James Fierro, he's founder and CEO of Eco Capacity Exchange Ltd, United Kingdom. We have as well with us Professor Conrad Tucker. He's Director, CMU Africa, Associate Dean for International Affairs Africa from the United States of America. We have also Mr. Liban Solman. Is he with us? Okay. We have with us my good friend, Mr. Goodstein. How are you? Amazing. He is founder and CEO of Catalyst Campaigns, United States of America. We have as well, to my left, Mr. Hibrander Misra. He's chairman and CEO of GMX Group and 013 from United Kingdom. As well with us, Dr. Thompson. I'm curious if Dr. Thompson made it to the panel. Not yet? Can you confirm if he's joining in a while? Okay. As well, we have my dear friend, Madame Nadia Filali. She is Head of Innovation and Business Development Group at Groupe de Caisse de Dépôt from France. We have as well Mr. Sacha Michaud. He's the co-founder of Glovo from Kingdom of Spain. We have as well with us Mr. Benjamin Arunda. He is Chairman of Africa Blockchain Council from Kenya. So I would like to ask you for a round of applause for our panelists for taking the time to join us today. And I will start with the first question to Mr. Ayoti. So in your opinion, dear Andre, what differentiates, the mic was on? What differentiates African fintech ventures that achieve sustainable scalability from those that remain pilot or donor dependent?
Good afternoon, everyone. Hello. Good afternoon, everyone. Bonjour. Assalamu alaikum. Just as a brief intro again, my name is Andre. I focus in investing in deep technologies in Africa for the past around 8 years. This is a very exciting panel when we talk about fintech. To note that I am not a specialist in fintech because our allocation is more sector agnostic and technology agnostic than specifically fintech. But I could say that we review approximately 300 to 400 fintech opportunities yearly. on the African continent. And what's particularly interesting about fintech and the conversation around it and the technology and the governance and so forth is in the past 5 years or so, there's been over $6 billion invested into the fintech ecosystem in Africa. And there's roughly about $10 billion worth of value in fintech today. So there's something that is not entirely perfect in terms of how we allocate and how we support and how also founders scale their companies in Africa, in my opinion. And specifically to your question, what we've seen in the past, whether it's across the B2B, the B2C, or even embedded fintech, we see those kind of fundamental 3 pillars that make a lot of sense in the ecosystem in Africa to scale and be successful as a fintech. The first one that's quite important is financial products are often truly commoditized. So if you're narrow and you focus on payment rails, that's your go-to market, it's easy to gain quick traction. It is extremely hard to be successful long term. You have a high CAC, a high cost of acquisition for customers. You have a very low retention rate. Customers are constantly looking for who has the best available rate, the cheapest transaction, and so forth. And the third thing is low margins. So you have this trifecta coming in, really squeezing everything for you not to succeed, and yet you end up with unit economics that is not sustainable. The second thing that we notice often and why fintechs are successful versus non-successful in the context of Africa is it is important to be very deep in the market that you are and then scale abroad once you're a dominant player in your market. And too many often we see Series A or pre-Series A with some foundation in a specific country and say we're raising 10, 20, $30 million to scale abroad, to scale in new markets. It is so challenging to scale cross markets in Africa. You have licensing issues, you have cultural differences, you have willingness to pay that differentiates between one border to the next. It is important to be great and strong and big in the initial market before scaling up. And thirdly, what we notice, those that have been successful, and at least in our portfolio, is those that are willing to invest, take the time, and own the infrastructure of the technology. Owning that tech stack that enables them to scale as they wish, not dependent on third parties, and also being able to adapt to the market. If you look at what's happening in AI, if you don't own a tech stack, it's really hard to remain competitive with the newcomers in the market. I'll give 2 examples of great success. If you look at M&T Hallen, which is an Egyptian, originally ride-hailing platform, they failed miserably with the ride-hailing. Unit economics were down, didn't work out. But however, they had massive access to drivers that were completely unbanked, often known to be, maybe criminal backgrounds. The banks didn't want to touch them. And then they also had access to women entrepreneurs. And that's how they started. They were very specific in terms of the product offering and being able to scale their product offering. It's a commodity. The more you have, the more you could get stickiness from them. Secondly, this Egyptian company grew really, really strongly in Egypt before going abroad, before going to Pakistan, before going to UAE, before going in the rest of Africa. And there's a big lesson here because the capital that they used was not for scalability abroad, it was scalability in-house, in their country, and also owning the tech stack. It took them 18 months to be able to own their tech stack and making them quite adaptable. The last thing I want to say, and this is, I believe it's true for the B2C, the B2B, and the embedded finance. And there's an incredible fintech story happening here in Morocco. If you look at Sharico, this was a B2B platform in the past, focusing on servicing the SMEs of Morocco. And now they're embedding their financial products across multiple instruments and catalyzing quite a big super app that's going to have big impacts on the country here. And again, the reason they're successful and the reason they'll be successful is because they have that strong base here in Morocco. They understand their market and they're scaling here. Secondly, they own that tech stack. That's going to fuel a lot to their success and be able to adapt to whatever it's happening in the market technologically or on the competitive side. And the third thing I want to mention is the instruments they're able to offer to their clients have very low margins. But when you start to talk about the lending, the payment rails, the remittance, the financing, now you're talking about a real business that's proven unit economics. Thank you.
Thank you, Andre. I'm really curious when you mentioned the difficulty of scaling business across Africa, and what do you think can be considered as a common mistake that is done by African businesses, especially? I will be a little bit selfish here. I will ask for specific type of enterprises, small to medium. What would be the common mistake that can SMEs do to prevent that scalability?
It's a great question. I think one of the biggest hurdle is around the licensing issues. We speak about fintechs here. We're not talking about getting a commercial license as in agriculture or other businesses, but licensing is a big hurdle. We're invested in fintechs across Africa. Going from Nigeria to Kenya is like starting from scratch, right? You have to go back to the central bank, you have to solicit, you have to make your case study, and it takes a long time. It could take up to 2 years. And imagine during 2 years, the central bank governor could change, and then you start again from scratch. So the biggest hurdle, in my opinion, is not so much on the founder side, but it's really truly on the policy making and the licensing issue. The second thing that I brushed on as well is I think it's really important to understand and differentiate that each markets are quite different in terms of culture, language, willingness to pay, middle class versus upper class versus lower class, and so forth. So the product fit has to truly align with the new markets you're going to. And often we see founders just saying, this is a big market in terms of population and demographics, therefore we go to Nigeria. And I think that's a mistake. Thank you.
Totally. I totally agree. And thank you, Andre, for these insights. So moving from scalability to innovation in financial architectures in Africa, I want to hear from you, Mr. James. So how can digital and financial architectures, including tokenization and programmable money and capacity-backed credit systems, unlock the new liquidity for intra-African and SME financing beyond traditional debt-dependent models?
Thank you. Great to be here, and thank you for your question. I thought it would be useful just maybe to give a little bit of context for this. I kind of started on a journey after back in the dot-com era, and I was trying to figure out what I could do that was meaningful, and I discovered this bizarre world of barter trade that happens, and it happens very much at the small business level, and it's the most visible aspect of it, but it is also happening in the biggest corporations and governments around the world, where China's going into Africa and, you know, building a $2 billion port and getting paid in gas rights. But it's not that visible that it's happening in the biggest companies in the world, but that is in fact where most of it is occurring. And so this small business layer was what I began to discover and study. And what was interesting is these small businesses were creating liquidity, not digital liquidity, but actual real economy liquidity by exchanging their respective capacities with each other. So the local restaurant was saying, you know, I'll be a member of some little exchange or cooperative, and I will allow people to buy my restaurant meals and get a chit that I can then use to go and buy flowers at the store down the street for my spouse. And when you start to look at what is happening there, it's an economy outside of money. But it's creating value from what was otherwise unused capacity. So the little printing company so they're making utilization of their capacity outside of the monetary economy. So it's creating incremental trade opportunities by making better use of capacity. And that for me was fascinating. And that led to a bigger study of that world. And it's happening in different data points, but the WTO estimates 6 trillion a year of non-financial trade around the world. So it's enormous. Try and find it. I mean, I spent years pounding the pavement and visiting big companies trying to figure out where is it. And when you go and look, and you learn slowly about transactions, GE is selling $150 million of turbines to China Railway and getting paid in frozen chicken. And you go, come on, really? Did they really do that? Yeah, they did. So then it kind of leads you down this path, and Boeing is selling jets to Malaysia and getting palm oil, and Caterpillar's selling equipment to Nigeria, and it puzzles the brain because the world is abundant in money. Money solves the problem of exchanging value, where you've got to try and make a match in an old-fashioned barter sense. So why is it happening? And that leads to really I think the architecture part. And what is the reason underlying why this is happening at that order of magnitude is because the global monetary system is failing. It's not doing what money was designed to do. Money's function today, if you just look at a few very basic data points. First one is global trade, monetary transaction is 1,800 trillion a year. Guess how much of that is real economy trade? Less than 15%. The rest of it is just financialization, money, trading for money, foreign exchange, and every other derivative and financial product you can imagine. And that is what most money transactions are today. So money has taken on a new life. It's not doing what it was invented for. It's actually making money from money is its primary function. And if you look at this small portion that is actually real economy, and that is at the heart of why GE has taken frozen chicken, is because not because money's not available. There's an abundance of it, but it is making money from money. It's not doing its functional purpose of acting as a medium of exchange. Well, that discovery was absolutely fascinating. So then I started to understand why this is happening. And then I started thinking, well, wait a minute. Think of Africa. Imagine that there was a system in the world that could unlock real economy capacity as a new form of credit, which is what it was in the beginning. Your wealth was how much capacity you had, how many sheep, how many cows. If you had a mechanism that could unlock capacity as a new form of credit, you would look at Africa through a completely different lens. In fact, the continent of Africa may be the wealthiest continent on the planet because of the abundance of capacity. So I was kind of wrapping cold towels around my head trying to figure out what the hell is going on. And what I ended up getting involved with a bunch of world-leading monetary economists. And Robert Mundell, after trying to pursue him to be on my advisory council for a year, I finally secured him. And you may know who he is. He's a Nobel laureate. He's probably the most renowned monetary economist of the last couple hundred years, according to his peers. And I said, look, would you be interested in getting involved with what I'm doing? And I spent a year going back and forth. And he said, absolutely. You are addressing the biggest systemic problem in the world that is holding back development that no one wants to talk about. And I said, the financial architecture, He said, no, financial architecture is quite efficient. It's the global monetary system. And you don't have to think very far to realize that the core, the root problem, and we've seen this evolution of fintech and payment rails and a plethora of tech-driven solutions to try and solve this issue that very few people understand. The root problem is money itself, and that's not what I mean. Then along comes Bitcoin and blockchain, and the world kind of goes, oh wow, this is going to be the answer. We got to get a more fair economic system. But if you dissect those solutions, other than blockchain is a very interesting technology, but the concepts of money that have emerged, they have many of the absolute worst characteristics that you could ever hope for in money. They're highly volatile. They have no lender of last resort. They got a lot of criminals involved. And so there are a bunch of fundamental issues in that world. But it caused a landslide of motivation by people around a hope that maybe this is an economic, a solution of economic justice. People wanted decentralization. Of course they do. But the reality, so, I just wanted to set the stage first that what is needed is a new architecture, a new financial architecture. The UN finally has recognized this on scale. They held earlier this year something called the UN Fourth Conference on Financing for Development. And there was a clear alarm that was rung by many thought leaders and the heads of IMF and the World Bank and so on, saying the global monetary system, they call it still the global financial system is failing. It's not the global financial system. It's the global monetary system is what is the failure. And so there's slowly a recognition of this. Now, from an Africa perspective, again, I come back to a very simple idea. Africa is abundant in capacity. Africa can finance its own future. It doesn't need FDI, foreign investment, high interest rate capital. It has a capability in its own asset base. The only thing missing is the mechanism to unlock it.
What an amazing and brilliant perspective, James. But you got me curious here when you mentioned that we need maybe a new financial architecture. I would love if you can a little bit elaborate on what does it mean concretely, on a concrete level, a new financial architecture, especially for people who are not from finance like me.
Look, use the most simple principles of it. If I have something of value, I'm a painter and I can paint your fence at your house, but I need someone to watch my children. So if you do that trade with me and I'll paint your fence, you watch my children, that's a beautiful trade. It brings back community. One of my other great mentors is D. Hawk. He's the founder of Visa, the credit card company. And he was on my advisory council for 16 years. And he said that what you're doing is so important because it brings back community. Think of the difference if I say, now, I want you to babysit my children. I'm going to pay you $10 an hour. It's a very different feeling than if I say I'm going to. So he said it creates community, which is sorely lacking in the world. And so the idea of just being able to facilitate trade. So we started with thinking we could do this with AI. And I worked with the IBM folks for a period of time. And originally a group called Firefly, this is more than 20 years ago, we were trying to figure, could we take all of the wants everybody has, we all have things we want, and all the people that have things that they want to give, and try and do matches. The problem was I have what you want, but you don't have what I want. So this is in economic terms a double coincidence of wants. And so therefore, how do we do a deal? Well, we don't. Unless I find a neighbor who has what you want, and we do but eventually the souk and the bazaar were the solutions for this. We'd all bring our stuff and we'd swap back and forth. But the real invention was money. But here's a really important discovery. Money in the beginning had two characteristics. Okay, any textbook or anybody who studies monetary economics, we read today, it has three characteristics. It's not true. Those three characteristics are a unit of account, a medium of exchange. Okay, that's what it was when it was things like shells and tally sticks. But over time, the rulers and the religious leaders started saying, well, we got to control this monetary system. This is how commerce is being done. We're going to add this other feature. We're going to make it gold, stamp our head on it. And now you've got a store of value feature. That store of value feature is what has actually corrupted money's function and made it an instrument of making money for money. So the architecture simply is being able to have a marketplace environment, and it can be anybody's marketplace, but you have to go back and invent the instrument that will allow the trade. So what we did is we created an instrument. We call it ECO, E-C-O. It's enterprise background. So you simply, if you're Africa or you're Morocco and you have a bunch of minerals, technically you can use that capacity to obtain a form of credit, interest-free, in the form of this credit instrument, capacity-backed credit instrument. And you can then use that to go and buy things that you would otherwise pay cash for. The only thing is you've got to make sure it's trustworthy. And you can't do that if you're not investment grade, because you're not investment grade, or if you're a small company. So you have to find a way to make it trustworthy, and that really is the key to kind of what a dozen years of work was about. And we do that by the instrument only ever being issued by an investment grade consortium. And so in the case of Morocco, they don't maybe qualify as an investment grade player, but you can wrap things around them to make them investment grade, whether it's a World Bank guarantee or otherwise, and therefore they can obtain the credit. So now they have credit, interest free, that they can use to deploy against infrastructure. Well, it dramatically increases the profitability of their projects, or reduces the cost of electricity in a renewable energy project if they can have interest free money. So anyhow, that's I don't know if that answers your question.
Well, you certainly not only answered my question, but you connected the many dots in my brain. And thank you for this brilliant capacity of abstraction and explaining complex notions or concepts. So you have mentioned something very, very important on the characteristics of money, or you have mentioned trust. And building on that, I would like to turn to Scott. I would like to ask you. Oops, it's all right. How can, in your opinion, how can lessons from political campaigns, you are a man of politics, help drive citizen awareness and trust in fintech innovation and initiatives?
I mean, it goes back to what James just said a moment ago. A lot of the fintech solutions are not always answering the question of what are we solving for. And I don't care if it's fintech, civic tech, the investor side is going to laugh at how many times they've been pitched what we would call, just complete vaporware. Where I think Africa has done a better job in solving very local problems. And this goes back to what Andre was saying. Like, you don't need to just be a programming army for some international company. You can actually solve a problem and scale a problem in your local and make a good living. You don't need to be a multinational player if you are solving a problem and making a decent product that is doing well. And so the young kids that I advise on different civic tech, is more really where my background comes from than fintech, is what problem is it that needs to be solved? Every political campaign I do, why are you running for office? What are you doing to solve? Like, these may seem like very obvious questions, but I think we've gotten away from it now that we're in our, whether we want to argue about it, second generation, third generation mobile tech. We're in our third or fourth iteration social media tech. Like, I don't know that we need another platform to do the connectivity anymore. Like, okay, we're all connected. Now, what is it that we're trying to do? And then one last thing I'll say on this is, it's an honor to be back at MEDays again. And I think that the Kingdom puts this conference together because these problems change year after year. And so we're all sort of dealing with this right now, where every investor is talking about sprinkling on a little AI to just solve maybe what they think is a problem. And AI is a wonderful, wonderful solution. It is not a noun. It is not, AI will solve that. AI will not solve the crisis that's happening in American electoral politics. AI will not solve a famine, right? Like, AI can help solve different pieces of the solution or of the pipeline. And so I'm not against AI, but I am saying a very cautionary tale of going back to literally what the colleague next to me just said of what are we actually using it for to solve a problem. I'll conclude with the good news and the bad news, because I think that there's good news and bad news around all of fintech. Look, the U.S. is wading into trying to make interesting policies that the politicians have no idea what they're talking about. So they're getting an issue brief from somebody, and we're going to hear in a second from my colleague Benjamin, who has to deal with this literally on a daily basis. The U.S. doesn't understand what it even means to hold a reserve of different types of cryptocurrencies. Are we holding bad currency? Are we holding good currency? Should the government actually be bailing out currencies that wanted nothing to do with government? Stablecoin is starting to do an amazing amount of good, but there's an education component of, if we haven't even figured out how to tell mom and dad when they're getting scammed on something else, how are we able to tell mom and dad, how are we able to protect a public good while not holding up technology? And so to me, going back to that question of what are we solving for, I also think we have to add to that question a value judgment. Do we want our country to have a bunch of spam technology? Do we want our country to be sucked into a fake cryptocurrency? There are several countries in Africa that Benjamin can talk to better than I can that are doing light years above what a lot of countries are doing in amazing cryptocurrency. But there's also the scam artists, and there's fake cities being attempted to be built, and there's a lot of stuff that is going to hurt a lot of people, that we also need to add a value judgment to this conversation around fintech.
You know, Scott, too many ideas are running into my head right now. I want to ask you, I have three questions, but I will start with something. You reminded me of a lady who was talking about what are we solving with AI? And she was like, I want AI to do the dishes, and I can write the book. I can concept the music. I can. So are we putting in on exact AI? Is AI used properly? And another thing you reminded me when you mentioned fake cryptocurrency and fake digital opportunities, you reminded me of a trend that was lately, I think 3 or 5 years ago. It was those people buying digital land. Do you remember this trend? Someone here remember that? No, not the NFTs. No. Yeah, something like no, not Web3. Like people buying fake lands, digital lands. Do you remember that trend? It was metaverse. Thank you. Where? That was. I know that there's Nadia here that can really enlighten us on this subject. But talking about AI, I will move to Professor Conrad Tucker. So, in your opinion, Professor, how can African universities strengthen AI to market pipelines to transform academic research into scalable fintech solutions?
Thank you very much. So for those who are coming in, I'm serving as director of Carnegie Mellon University, Africa. And as it relates to your question, one unique aspect about the university is that we have students from over 20 African countries that are represented there. And when you connect that back to the scalability conversations, if a startup company is looking to scale beyond Rwanda, as an example, now they have former colleagues and students from different countries who can help them reduce the risk profile in a country of origin. And there are many successful startup companies that initiated at CMU Africa that are now scaling across the continent because they have co-founders who are originally from those countries. As it relates to the overall theme of this forum of digital sovereignty, education and research play a critical role in the realization of digital sovereignty, specifically as it relates to fintech. Now, of course, fintech is broad, but I'll focus on one of the areas that the university is working with our partners to advance, and that's the digital inclusion for the everyday user, the user in the village, the unbanked, which represent millions of people around the world, and specifically on the continent. And so we're asking individuals who, for the most part, have kept their money and treasures under their mattress to trust a digital technology system, leapfrogging a bank. In many cases, the physical bank was unavailable to them, so this motivates the use of a regular cell phone that can now serve as a way of moving money. So this presents an opportunity for the unbanked for financial inclusion, but it also introduces a new trust component where an individual now having spam messages increases the risk that they may, again, because of their newness to this new banking system, become susceptible to smishing attacks, fake text messages requiring them to send mobile money to an unknown user. To mitigate these issues, CMU with our partners are working on AI solutions that can be embedded on top of these cell phones, so that the end user who may not have a lot of expertise in deciphering what is fake and what is a authentic banking text message would now have this added layer of security on top of their financial digital transactions. And that's absolutely important if we're going to scale the access to the unbanked, because as we scale, if the trust starts to reduce, then that presents several challenges. I'll end on the topic of interoperability that we've spoken about. There should be no reason why, moving from Rwanda and going to a neighboring country, you should not be able to send money using the same digital infrastructure. So it seems like we're and it's not a technology problem, right? These are policy constraints, and if we can overcome these policy challenges so that we can have more interoperability when it comes to the movement of digital transactions, let's just focus on Momo. I think it would really do a lot of benefit for the unbanked and individuals who aren't using traditional financial systems. Thank you.
Thank you. Thank you, Professor. You have mentioned digital sovereignty and governance of fintech, and I would like to bring a European perspective to the panel for a new perspective or a best practice, maybe. I will turn to you, Madame Fileli. In your opinion, Madame Fileli, how is France's public sector leveraging blockchain for transparency and efficiency in financial governance?
Thank you. Merci, Myriam. I will switch in French if it's possible. Et je pense que dans ma réponse, je vais aussi réagir aux propos de James et de Scott.
I really was looking for that.
Sorry. Alors, en réalité, le secteur public, et si on parle du secteur public ici, on va se concentrer quand même sur la partie financière, donc que ça soit le régulateur ou la Banque de France, au départ, n'est pas trop partie sur des blockchains publiques, plutôt sur des blockchains privées, et au départ, il y a un peu moins de 10 ans, sur des cas d'usage à faible valeur ajoutée pour tester, et notamment sur des sujets de référentiel, etc. Je pense parce que les premières questions qui sont arrivées dans les réflexions des gens, etc., étaient plus autour des crypto-monnaies dont a parlé Scott tout à l'heure, et que c'était quelque chose qui n'était pas maîtrisé, qui faisait peur et qui n'était pas forcément régulé. Il se trouve que depuis, on a la chance, alors au niveau français et au niveau européen, d'avoir régulé les crypto-monnaies, avec d'abord dans le cadre de la loi Pacte en France, qui a été la base de la réglementation européenne, qui est devenue MiCA, market crypto, enfin in crypto asset, et qui est quelque chose qui va être là mis en exécution et qui va permettre de clarifier, enfin et qui permet de clarifier l'usage des crypto-monnaies qui sont émises sur des blockchains publiques, l'usage des stablecoins notamment, pas l'usage des NFT dont on a parlé tout à l'heure parce que c'est un objet un peu inidentifié ou inidentifiable et en plus c'est un peu mort quand même. C'est pas très à la mode. Ça c'est le premier point. Et ensuite, je pense qu'il y a aussi une évolution qui est que les marchés financiers privés ont en fait commencé à essayer de monter des infrastructures blockchain privées, ce qui signifie elles ont une gouvernance qui était entre banques ou entre opérateurs de marché, etc. Et qu'en fait, très vite, ils se sont rendus compte que d'abord, c'était compliqué à faire, que c'était pas forcément très efficient, et que surtout, on était en train de réinventer le système qui existait déjà. Bon. Donc aujourd'hui, on a une ouverture au blockchain public qui est plus évidente aussi parce que si on est sur des blockchains de type Ethereum ou autre, on est peut-être moins consommateur d'énergie parce qu'on a appris à faire des couches en parallèle, ce qu'on va appeler des layers 2, qui vont permettre de faire plus de performance, et parce que quelque part, on est plus à l'aise en fait avec ce qui se passe là-dessus. L'autre accélérateur, il est très politique, je pense que Scott va voir de quoi je parle, c'est qu'en réalité, aujourd'hui, et c'est là où James, moi je vous rejoins pas complètement, parce que ça peut être un outil géopolitique important et de manipulation, et qu'aujourd'hui, quand les États-Unis lancent le Genius Act en juillet et libèrent totalement le sujet en étant totalement transparent, en disant je vais financer mon budget par l'émission de stablecoin en US dollars. Je vous rappelle que les stablecoins en US dollars représentent 99% de la masse monétaire de stablecoin dans le monde. Et le traiter comme un outil d'intermédiation du financement budgétaire, du déficit budgétaire américain, là où les Européens utilisent la monnaie comme un outil de politique monétaire pure, on arrive à quelque chose qui devient une question de... Alors, on a eu une table ronde ensemble hier, et on arrive à une question de souveraineté qui est quand même pas neutre. Donc ça, c'est un point qui a fait réagir l'Europe, et aujourd'hui, vous avez la Banque Centrale Européenne qui a lancé 2 projets, Pontes et Appia, alors plutôt sur la partie règlement livraison sur les titres, mais vous avez des réactions, et vous avez, nous en ce moment, on travaille avec la Banque de France pour pousser à ce qu'il y ait des stablecoins privés et sur des blockchains, enfin, potentiellement publiques aussi, pour contrecarrer cette domination qui est que d'un côté. Bon. Mais là, on est sur un volet peut-être très institutionnel encore aujourd'hui. Après, il y a aussi un changement un peu de paradigme parce que il y a en moyenne 10 à 14% de la population qui utilise des crypto-monnaies en Europe. La majorité, ce sont des hommes de moins de 35 ans, donc ça ne représente pas toute la salle, on va être très clair. Voilà, qui l'utilisent pour de la spéculation essentiellement, ou comme une espèce de placement d'épargne. Bon, pourquoi pas. Ce qui est intéressant derrière, si quelque chose devait se développer par rapport à ce que vous avez dit, c'est si derrière on arrive à créer une interopérabilité entre des systèmes financiers un peu plus classiques et des systèmes financiers qui vont plus ressembler à de la finance décentralisée, même si je vais mettre un caveat là-dessus, sur lequel on est certain qu'on a traité toute la partie conformité qu'il faut mettre en place. C'est-à-dire, moi j'ai un sujet sur l'identification des gens qui travaillent sur ces chaînes, sur la compliance, le KYC, etc. Vous avez parlé de fraude, il y a plein de gens qui sont quand même fait avoir. Alors là, peut-être ça peut devenir un instrument intéressant qui va permettre de financer l'économie, qui va permettre de financer des petites et moyennes entreprises, parce qu'on peut découper un certain nombre de choses, parce qu'on peut faire... Voilà. Ça c'est valable, et c'est valable, je pense, aussi en Afrique, si on est dans un cadre qui n'est pas complètement dérégulé. La réglementation en finance, c'est pour ça que je ne vous rejoins pas complètement. La réglementation en finance, elle n'est pas là pour embêter les gens, elle est là pour protéger en fait. Enfin, en tout cas en Europe, elle est là pour protéger les épargnants, les investisseurs individuels. Elle est uniquement là pour ça. Et donc si vous oubliez cette partie-là et que vous ne protégez pas les individus sur toutes les arnaques qu'ils peuvent avoir, ou si vous ne les prévenez pas qu'en fait ils peuvent tout perdre d'un jour à l'autre, je ne suis pas sûre qu'on apporte de la résilience ni en Europe et alors encore moins en Afrique. Et donc, c'est pour ça que moi, je suis pour un système qui soit un peu mixte, où il y ait des acteurs innovants et des acteurs classiques, voire même à réfléchir. Alors, ça va être un peu... Ça, c'est moi qui parle sans aucun titre ici sur cette table. Même à réfléchir le rôle des acteurs bancaires et financiers et le modèle économique des acteurs bancaires et financiers. C'est d'ailleurs pour ça que ça va peut-être pas aussi vite que prévu, parce que ça va détruire un certain nombre de marges de création de valeur et d'emploi, d'ailleurs, il ne faut pas oublier, tous ces sujets-là, que ce soit la blockchain ou l'IA même. Alors ok, mais il faut qu'il y ait un équilibre entre les parties et que ça ne déséquilibre pas, enfin que ça ne vienne pas à l'encontre des populations. Parce qu'autour de la table, ici, on est à peu près éduqués d'un point de vue financier. C'est pas le cas partout. Je pense que c'est pas le cas partout en Afrique. Moi, j'ai vécu au Maroc et mon premier chéquier, il devait y avoir 10 chèques dessus. Et je me suis dit, c'est bizarre, pourquoi on me donne un chéquier avec que 10 chèques dessus? Parce qu'à cette époque-là, en fait, il n'y avait pas beaucoup de monde qui avait un compte bancaire. Parce qu'on ne donnait pas de compte bancaire avec des découverts au Maroc, en fait. Parce que les gens n'avaient pas tous un salaire sur un compte bancaire. Et c'était pas il y a si longtemps, parce que j'ai un certain âge, mais quand même. Donc il faut faire attention à ça, et je sais qu'il y a quelqu'un dans cette salle qui est sensible aussi à ça, et il y a des femmes n'ont pas forcément non plus une connaissance financière importante ou une gestion, enfin... Donc je pense que c'est essentiel d'arriver vers des choses innovantes, effectivement de pouvoir... J'ai un peu dépassé ta question Myriam, mais désolée, mais de pouvoir... faire en sorte qu'on rend plus efficient le système financier et bancaire et les services financiers bancaires en Europe et en Afrique, parce que là, je pense que c'est l'essentiel du sujet. Mais il faut le faire de façon raisonnée et raisonnable, avec une coopération entre les acteurs fintech et les acteurs financiers classiques, mais surtout pas déréguler, acculturer les gens et faire attention aux mauvaises idées d'arnaque ou de fausses, enfin, ou de fausses monnaies, de faux cryptos, etc. Moi, demain, je peux créer un Medcoin si je veux. Je pense que je peux même le faire en quelques minutes avec mon téléphone portable. Donc, je suis pas sûre que j'ai aucune garantie sur moi-même. Voilà, merci.
Yes, yes.
Just a couple very quick comments. Thank you, Nadia. I loved your comment about unidentified objects. And I mean, it's perfect. It's, fake, not fake, who knows what you're getting. There's 40,000 cryptocurrencies when I last checked. There's 100 stable coins that have been launched into the market in the last 2 years. There's probably another 500 coming in the next, we're in the middle of stablecoin fever. There's going to be, a plethora of others coming. And this is hugely problematic because it's, as Bill Gates says, it's the theory of the greater fool. As long as there's someone dumber than who bought last to come in, everyone is okay. But when the music stops, everyone's going to be running for a chair. And on the regulation front, yes, indeed, we have to protect people. That is fundamental. And that is one of the two pillars of what regulation is for. But prudential financial regulation has really two things. One, it's to protect the stability of the monetary system at the national state level, and then to protect investors from not, individuals from not being taken advantage of. So these are just the two comments I wanted to make.
Thank you, James, et merci Nadia pour ce commentaire. Et moi aussi, je rejoins parfaitement le point, l'importance de la régulation, surtout avec un système mixte et équitable et inclusif qui a pour but de protéger les investisseurs et les investissements et pas que contrôler la sphère financière. Donc, sans ces frameworks, je suis d'accord. Sans ces frameworks de protection nationale ou continentale, ça risque de pénaliser un peu les investissements et l'attractivité business pour notre pays et notre continent. Building on that, sorry for the brutal language switch, I will go back to a question on investment. Since we're talking about investment, I will turn to Mr. Sasha Michaud. I would like to ask you, where do you see the most exciting and strongest opportunities for investment in Africa's tech ecosystem as someone who is investing in technology?
Yeah, thanks. I'll give you my perspective from a business manager doing business in Africa, but I'm certainly by no means an expert. But I do travel to the countries and I see what's going on in the local ecosystem. I think, first of all, I mean, we all know this. The continent, is the fastest growing continent in the world. It's the most youthful. I think the average, medium age in the continent is around 20 or something. I think Europe, it's about 33. I mean, it's a massive jump. So that per se is just an opportunity. There's, I think, close to 10 countries with over 50 million population. We operate in Nigeria. In theory, and this is our vision, Nigeria should be in global's biggest market in 5 years' time. And so the opportunities from just that perspective, that's not even talking about technology, is absolutely amazing. For me, there's three elements that make a market attractive or make an ecosystem work. The first is access to capital. The second is talent. And the third is regulatory framework. Now, the first, I think, access to capital, it's clear Africa, is behind other regions. So therefore, the possibility of building a huge tech company are limited if you're competing against, a company in Silicon Valley who just goes out with a term sheet, with a deck, and he raises 20 million with just an idea. The same thing's happening with talent. Now, there's probably a high probability that probably in some engineer in Google has probably got the tools that he's learned there a lot more than even somebody in Europe, let alone Africa. So, and then of course regulation, which is a tough, you need solid regulation and you need regulatory security, I would say, right? So talking about global and why we launched with all these things, because we saw the opportunity of growth and we saw a free playing field. A lack of competition, a possibility of moving in with a service that was very useful, very local. I think Andre covered that as well, really well. We're in a number of markets here, they're totally different. Our Moroccan business, which is huge, is probably closer and the way we operate to our Spanish business than it is to our business in Nigeria. So there's mass differences between the markets and how we've confronted them. And that, to me, is the biggest opportunity. I see an opportunity for local entrepreneurs to build local businesses that Europeans were not going to build them, and Americans are not going to build them, and solve problems. And there's a lot of problems to solve on the continent, and that's an opportunity per se. And we're seeing that. We're a foreign company. We're a European company. We're investing in Africa. We're growing. It's our fastest growing region in the world. The unit economics work as well. They're profitable. Every single market in Africa is profitable for us. And then we're beginning to notice in certain countries more than others the talent aspect. And Morocco is a very good example. It's the country I probably visit the most because it's our largest market in Africa, but also it's very close to our headquarters in Barcelona. And the level of talent here is, in my opinion, second to none. We're talking about Moroccans who've maybe studied or worked abroad are now coming back. We're talking about talented Moroccans who are not leaving the country to build a company. They want to do it here, and that is a huge opportunity. And also similar, Nigeria is another good example of that where the talent level is super high. I think capital, we're away from that, and I think it goes into the third piece, which I said, which is I think what's stopping more investment and more funds, and especially large ones that really are game changers, is regulatory security. You know, can I invest in this country and there's change of government and 2 years down the line I don't have to close down my business, and I think that needs to be addressed. But it's also an opportunity because there's less baggage here. You know, Europe and the EU has a lot of regulatory problems based on they have to undo a lot of regulation that was done 20 or 30 years ago. And that's really difficult because often those regulations are not vote winners, although they. And a lot of African countries, the ones I visited, and part of that is talking to regulators, is actually they feel they don't have that baggage to undo. No, they can reform new regulation based on modern society, which has obviously changed dramatically since obviously since the start of the internet and technology. So I'm super excited about the region. We're continuing to grow here. We're looking at new countries to launch as well. So yeah, I think it's a great opportunity, and I think it's the lack of competition, the fact that it's a free playing field, and it's very local. So you're not going to get many companies coming here and taking over the space. You can get your space, and you can build huge businesses in one country. No, it's not in Africa, but I'll give you an example. I always use this because we're also in that country. It's Central Asia, Kazakhstan. They built an e-commerce fintech company that is worth close to 20 billion euros in one country. He's on the stock market as well, in the London stock market, Caspi. Amazing business local there. This is one country built a business, which is this is the sort of thing that can be done in Africa. Because they can build these super apps that really fix local things and facilitate things. And
Brilliant. Thank you, Sasha, for all these insights. Very brilliant insights. First of all, I'm super curious. I have a curious question. I want to ask you, what is the meaning of global?
yeah, that's a good one. Global is actually balloon in Spanish, but with a B. But if you write on the internet, and it's pronounced the same, the V and the B is almost identical. So if you say global, but balloon is actually, if you write on the internet, there's about 20 million or probably 500 million results because balloon is quite a popular name. So we switched it to the V, which doesn't exist in Spanish, but it's pronounced the same. And we chose this name for a couple of reasons. It was short, but it was very pronounceable in pretty much any language. So we had this vision that we wanted to build a global brand. And then it coincides as well. My co-founder, there were two founders, he was actually an aeronautical engineer, so he was thinking about something in the sky as well, so it sort of fitted in. And yeah, and our first logo, actually, we bought a balloon online, and I think it cost us $10. And we started growing a little bit, and I think it was a year 18 months or something. I said, we better do our own logo. I mean, we're getting quite big here. We can't just buy a logo off the internet for $10. But yeah.
Franchement, honestly, it's an impressive model. It's an impressive, and congratulations for the job you're doing. And you've mentioned many important aspects related to investment, and one of the one that really caught my attention is access to capital. And I would like to mention that in entrepreneurship in general around the globe, access to capital is not that equitable, since for women entrepreneurs, only 2% of women entrepreneurs are getting access to capital. So there is a huge gap that we should maybe at least think about. And I would like to hear the perspective of Madame Nukoi on this matter. As yourself, you are an entrepreneur and you are doing amazing work in the tech sphere. I'd like to hear about you. What do you think on this matter?
Hi, everyone. Good afternoon. Thank you so much. So hi, my name is Jenny. I am the CEO and founder of Clafia. I like to describe us as a digital health bank where you can finance your health and also access healthcare on the same platform based in Nigeria. So to be honest, as someone who was starting a company or starting Clafia back in 2021, I like to think of myself as someone who can just go and do things and not really consider like any barriers. So I didn't see myself as a woman entrepreneur. I didn't see myself as a Black woman entrepreneur or an African entrepreneur. I just saw myself as someone who wanted to build a company in Nigeria. And it was until I started building my company that I started to get all these notice and get all these labels slapped on me. Um, Maybe work to my advantage, but I feel like in a way work is working towards working in my disadvantage to me. You mentioned a stat. I've heard this stat like year in, year out, about 2% of women globally get access to venture capital or capital in general. And then if you start to drill down on those numbers, you find that it's even harder for like women of color, um, women on African continent, and it's much harder for us to raise capital. Um, and we have these talks every year about what can be done about it. And to be honest, I I think what I would say is I don't want to say to look at me as a woman entrepreneur, look at me as someone who is actually building something on the continent. If you want to invest in more women, I don't think there's anything that's stopping us from investing in more women. We just have to do what needs to be done. I mean, I would say like some of the barriers, as someone who's also raised some venture capital when I've gone to speak to investors, I'm being asked questions that aren't necessarily like related to how I'm going to build a company, such as, am I married? Do I have children? Do I plan on like getting married? How is that going to affect, um, building my company? Do I plan on getting a male co-founder? I don't think any of those things really matter in the grand scheme of things. But these are questions that I'm asked. And when I compare myself to my male counterparts, I find that they're not really asked those questions. In fact, it's more, I'll say like when I've seen my male counterparts in Nigeria raise capital, it's done in more informal ways. They're done at, they go to a bar and they meet with the investor and they just grow a relationship from there and they decide to invest. As opposed to someone like me, I find that I have to kind of build that. Yeah, exactly. Prove myself. So, I mean, to be honest, as some like what I've started to do is I don't want to say like operate as a man, but do those unconventional things that also help me help me like get access to capital, which is like building their relationships. I'd also say it'd be helpful to have more women investors in the space. When I look at a country, Nigeria, there aren't that many women led funds and in Nigeria, so that also like diminishes our access to capital. Um, Big donor organizations have stepped in to fill in the gap, but to be honest, I do feel like again that could be a disservice because then if we start to rely heavily on grant funding, the question is then being asked, is your company sustainable without grant funding? And we don't want to invest in a company as it's going to continue to rely on grant funding. So I'm not sure if there's a straightforward answer on what needs to be done. Um, I just feel like if we really wanted to increase access to capital for women and women of color, just do it. Just do it. And because the women I know, my counterparts, they're building amazing businesses. They're building businesses in spite of access to capital, having the opportunity to get access to like the best talent, right? They're doing these things in spite of it, being married, having children, and they're still getting the job done. So I just would hope that one day, maybe next year, that I hear 3% and not 2%.
Oh my God.
I would love for it to be more than that, but I would hope that that number at some point does start to increase and not next year we hear 2% of women get access to capital globally. Thank you.
Uh, Actually, I'm really glad I asked this question. I know it wasn't planned. I'm sorry for that. And I mean, I'm so glad because you just gave hope to the young ladies who are joining us in this session. And there are plenty of students here. And maybe one day future entrepreneurs. What Nwoke just said is that just start if you have an idea. I'm sorry, this is off script. It has nothing to do with the panel, but I will take this opportunity to encourage you all, especially girls and women, to if you have an idea, work for it and fight for it, and fight to get the capital needed in order to get your idea to life. And back to the subject, the core subject with you, Benjamin. So I would like to ask you, could Africa design its own Pan-African blockchain interoperability? I have so much troubles pronouncing this word. Can someone say it in my behalf?
Interoperability.
Thank you. I will continue. Protocol to lead the global standard setting. The floor is yours.
Thank you, Miriam. So when you talk about blockchain, first I would like to say that I think crypto has made blockchain more complex. There is a phrase I coined a couple of years ago that I named the crypto poison. And the crypto poison is what, in my view, was in my early days in crypto. I could attend most of these conferences, travel across the world, attending conferences in Asia, in Europe. And one thing was common. There is an unusual focus on the crypto and a neglect on what is the underlying technology. So looking at it in the early days of internet, imagine a focus where you attend every conference and it's about email. It's about how can we send more emails, how can we create more emails, yeah? Because emails are what people are using on a daily note, you know? Nobody cares about internet. People care about what they can do on the internet. So I tend to think that what we have lost on the part of blockchain for years as Africa, and globally for that matter, because crypto has still stolen the show, even to date. When we talk here, we talk about crypto, we talk about 40,000 cryptocurrencies, we talk about how we can create new cryptos on Ethereum, right? We talk about NFTs, what Nadia has clearly called as unidentified objects. Yeah, so what I see in all this is innovation. Yeah, in the early days of internet, how many websites did we have? Several, right? Some of them were just useless websites, you know. Provided I can create a website, I'll put it out there. So for me, before I answer your question with regard to interoperability, because this is a question of innovation, it's a question of solving problems. Yeah, revolutionary technologies are not always gonna solve problems. Revolutionary technologies are gonna stay a while before they can even solve real problems. And I've said it a couple of times that the people who always adopt revolutionary technologies fast are always criminals. Why? Why do criminals don't think twice before really adopting new technologies?
It's actually a fact here. Cryptocurrency and using digital money is actually seen or perceived as something criminal or doing something fraudulent.
Yeah, so it's interesting because it's a mindset. I mean, I'm a lawyer and I work in policy, and for the last couple of years, I've worked with a couple of governments across Africa. I have sat in boardrooms with policymakers, trying to convince ministries of treasury, central bankers, with regard to how discussions around blockchain. But you see, always the understanding has always been how can we get this animal out of the room? You know, governments have been fighting to protect centralization because of what we have pushed crypto as: decentralization and, yeah, freedom, quote unquote, liberty at last. You know, so meaning that we are, at long last, we want to govern ourselves. And our monetary system, as James talks about, I mean, we need a new monetary system. Our monetary system in this liberty of freedom world is crypto. So when you talk about building an interoperable, or rather an Africa, a continent-wide protocol for interoperability with regard to blockchain, there are a lot of things that we have to put in order before that can happen. Yeah, it's really, in my view, like, I mean, we decide that, hey, we want to rear all animals in the same room. You know, let's bring the hyena, let's bring the sheep, you know, let's bring the elephant, let's bring the leopard, let's bring the cow in one room. Yeah, so that we don't have to fragment all these feed. You know, you feed the animal there, the elephant there, the lion the other side. So bringing all these animals in one room, because the way the national centralized financial, or rather payment infrastructure is built, it is built to keep away any form of decentralization. It is built to keep away a blockchain and the likes. Yeah. So it is very difficult for any system whatsoever, whether you talk about land, whether you talk about digital identity, whether you talk about payments. It is very difficult to just bring crypto, yeah, or blockchain, yeah, into government. So I'm gonna, as I finish, I'm gonna mention three things. One is regulation, policy making. James did talk about policy making as well, and Conrad as well. Policy making, in my view, is not just two. I think governments focus on three areas. For many times, two areas with regard to policy making in cryptocurrencies. And the two areas have been, one, consumer protection. Why? Because crypto, the hype in crypto, this thing is, I mean, not just the hype, and it's not, governments have not been mistaken, by the way, to protect consumers, because we can clearly see what's have been going on in crypto. I mean, since 2017 in Kenya, I can't count how many crypto startups that have raised millions of dollars, right, in Kenya, and then disappeared into thin air. Yeah. I mean, they open a website and, you know, you sell crypto. Some even want to sell physical crypto, you know, and they go to the least financially included in the villages, you know. You can hear of widows selling their plots of land, their cows, to purchase this cryptocurrency that is gonna jump to millions, you know. So consumer protection is not mistaken. That is the number one role that the government have to play, and play it perfectly well. Yeah. So unless, as crypto players, we behaved in a way, or played in a way, that needed no consumer protection. Second is revenue collection. In Kenya, in 2023, the government, through the Finance Act 2023, introduced a crypto tax, a digital asset tax. At this time, we did not have the current Virtual Asset Service Providers Act that was introduced this year. And at that time, we were lobbying and we were asking questions. How do you introduce a tax before even a proper regulatory framework? So you're taxing what is not regulated, you know? So what we understood is that, because at this time we were having conversations with the regulators. So what was clear is that the regulator, through these conversations, realized, and through data published by the UNDP and a couple of other entities, how much money is flowing in crypto through the Kenyan economy. Yeah, and it is going in billions of dollars. And the government was like, we are not, this is money we cannot tax. Yeah. So they had to introduce tax without waiting for the regulatory framework. So third is what governments have missed is what I call promotion of innovation. So in my view, and that's where regulatory sandbox also come in. Yeah. So it shouldn't just be consumer protection and revenue collection. And a key aspect is also promoting innovation. That is a key part that should also be looked at. So my last statement with regard to answer you now with regard to interoperability. So you can realize that we have a lot of fragmented things here that already are a hindrance towards having a single protocol, an Africa-wide protocol with regard to blockchain. Data, we have the Africa Union Malabo Convention. That is a proper guidance with regard to data protection. But I can tell you for a fact that most African countries still do not have a Data Protection Act. Yeah. And you look at a couple of countries, you see a copy-paste of the GDPR without proper context into Africa. You know, GDPR works well, of course, but you have to put context with regard to which location you are in, yeah, and what is practical. So we need proper data protection laws. We need digitalization, yeah. We need to have digitalization, and then we need some harmonization with regard to regulatory frameworks across Africa with regard to crypto, yeah. Then I think it is possible and practical, technically and even politically, to have an interoperable Africa-wide protocol for blockchain. Yeah, that is possible politically. We need to have a political institution. I mean, this can be done through the AU, digital bodies, or the Smart Africa and such institutions. Then, I mean, the technology part is the easiest part. The technology part is the easiest part, and that should probably is the one that should come last. Once we deal with the issues of the underlying issues of infrastructure and the underlying issues of data and regulatory.
Yes. Yeah. Thank you so much, Benjamin, for all these structured insights, especially regarding infrastructure and regarding the importance of regulation. You've mentioned something very important, which is a practice that will remain existent, which is, I mean, unfortunately, there are people who will be scamming the most vulnerable in the villages, in the rural areas, in order to scam them through some social engineering strategies. And that highlights the importance of regulation. And I would like to jump to a question a little bit more technical to Mr. Hirander Mithra. So I would like to ask you, what is the role of tokenized exchanges and ESG-linked assets? What is the role played in the next generation of African capital markets?
Thanks. Good afternoon, everybody. Last but not least, and thank you for sharing the mic, Miriam. So it's interesting. I mean, I'll just set some context because we've been involved in various African countries as a business, as GMEX Group, for about a decade now, just over a decade. And why did we get involved? And it's quite difficult at the start, actually. So having spent 30 years in securities exchanges, and at that time 20 years, we saw that capital markets across Africa weren't really achieving their objectives because, you know, Sasha mentioned the Kazakhstan listings as well. Even Kazakhstan has 2 stock markets, yet the most valuable companies listed in London, even though the London Stock Exchange has its own issues. So we saw that capital markets in Africa had lost their way, and you know, we've spoken about private capital here as well, but public markets weren't really serving purpose. So we decided the digital technology existed even then, you know, given that blockchain was around with Bitcoin since around 2009, to enable those markets in a different way. And we started doing that with a venture that we had, Altex in Uganda as well, which still exists today. But the challenges we got was, yeah, I mean, from Mauritius, which generally is considered quite good from a African structuring standpoint, we wanted to set up a Pan-African exchange, but we realized, I mean, there's no such thing as Pan-African regulation, and each jurisdiction, and this is pre-digital assets, but each jurisdiction had its own regulations, had its own central bank governance standards, payment standards as well, and everyone was at different stages. So even though technologically the technology existed, as Benjamin eloquently put forward, there were other barriers to entry. So, if we look at that, what we then had to do was, okay, set up individual exchanges, but interconnecting them was difficult. I mean, again, Benjamin speaks about a common blockchain protocol for Africa. This is where I differ slightly, where there's multiple protocols. I mean, everyone speaks about blockchain as one ubiquitous technology, but as many of you know, and Benjamin, you know this as well, I mean, there's many blockchains out there. And in many ways, we've gone from a system that's been standardized with SWIFT and recognized payments to one that's completely fragmented now. And, interoperability has been mentioned by a number of our speakers, James, Professor Conrad included. Now, the issue is unintended consequence. We've ended up in a worse situation today than we were in before. And actually, there's two key elements here. So the technology is fragmented. So we don't get the platform distribution, and there are many platforms. There are walled gardens in country with policy, and there are many, many initiatives, and everyone wants their own initiative to prosper. And everyone speaks about interoperability, but those with the market share don't really want it. I always used to say, I don't like monopolies unless I become one, right? So it's that age-old adage, and everyone on the other side of the fence wants to get in. So one, platform distribution is a challenge. The other one is, and this comes time and time again from speaking about the monetary system not serving as well or failing. So we're talking about asset monetization, access to capital, which most of our speakers spoke about being a challenge. So access to money. So the technology is one thing, but you could have the best technology in the world, but if you don't have that monetization of the underlying assets and the money flows, it's redundant. Now, I mean, that's a problem statement, but how do we look at how some of these challenges are addressed? Now, we speak about alternative financial systems, and really I would argue, I mean, why has the system failed? Because when we looked at it then, and I'll fast forward as well from that time in 2014, 2015, and we tried tokenization with gold in Mauritius in 2018. It was too early, and there wasn't a will. I can speak about this because, the previous regime, there were some ease of business issues, and even though it made sense for the country, and rationally it made sense to make that a hub for securitizing gold and digitizing it, it didn't happen. So when we look at those challenges, the biggest problem we've got is, I mean, if we look at most African countries, I think other than Botswana, the last time I looked, every single country has a balance of payments deficit. Even Seychelles, that used to be the other way positive, has that. So we're swimming in debt as a continent. Yet, if you look at each individual country and the natural asset pools that we have, we're very rich in natural assets. I mean, I was engaged, I was at COP30 just a couple of weeks ago, and I was speaking to the DR Congo government. And there's a plethora of natural assets there, and this plays out across every single African country. There's huge projects from Morocco and renewable energy to agroforestry, in the Great Rift Valley with the Kapsagat forest in Kenya as well. And I spent a lot of time in Kenya. But the problem is it doesn't translate at a macro level and a micro level as well. Costs have gone up since COVID, and people are struggling to make ends meet. So how do we address that fundamental macro challenge, and how do we do that at a micro level? Now, you could argue actually the debt-based approach internationally has failed. I don't think institutions have served the purpose, because not to pick on Kenya, but it's an economy I know reasonably well. The IMF debt window is relatively low. So His Excellency President Ruto then, with his cabinet, thinks, okay, tax increases are the answer, yet that leads to disaffection and people coming out on the streets. They don't realize it's because there's a macro impediment standing above them. Take another example, Malawi. There's been an election recently. So USAID accounted for $1.2 billion every year. Even in Kenya, I was there the day USAID disbanded, and impacted everything from healthcare to a number of other services, not just NGOs and those levels of local projects. So what's Malawi's budget deficit? It's about $1.2 billion now. There's a big challenge there because they can't lend any more from the international institutions. The credit ratings themselves, which we won't go there today, but aren't really fit for purpose because they always underrate us in Africa. They don't overrate us or even bring us on par. So cost of credit is very, very expensive. Plus, currency risk isn't completely hedged because the large international institutions are making money from this. So about 30% of African currency risk is hedged, and we know there's been currency devaluation because of some of these macro challenges. So I would argue now the fundamental model, I mean, James spoke about going back to barter. In many ways, Africa has to go back to its natural asset pools. We've seen that with President Traore in Burkina Faso and what he's spoken about. And this isn't just about shutting the West out, but I think there's got to be a more equitable model. With that, many of these countries have natural assets, both at government level and private assets. Where blockchain can play a part now is going back to real value. Again, I come from the regulated market side, and there's two aspects to this. I mean, one, if we can securitize our natural assets and there's a broader distribution mechanism, and we've started to do some of this as an organization. We started ironically with carbon because there's a $4 trillion financing gap, but then we realized actually no matter how much companies talk about ESG and not net zero, even the big tech companies, they only wanted to assign very small proportions of their budget, less than 1%, for carbon offsetting and decarbonization because they want to make money. So then we realized actually carbon offsetting and decarbonization is one thing, but when we combine that with natural assets and water, energy, food security assets, and they're in abundance across Africa, all of a sudden you're creating economic opportunities at the community level, at the company level, and at the country level as well. So a lot of the work, and it's led us from 2014 to understand that a lot of this revolves around unlocking the value of those natural assets. Now, what kind of capital can come in? I've said that public markets have not really served their purpose. Even the London Stock Exchange is struggling. Most of the tech companies that exit list on NASDAQ because the US market's forward value companies about 40% more than Europe does in terms of valuation, because we don't really factor in Europe forward valuations, which makes it very difficult to raise on big moonshots that we were speaking about before we headed on into this panel. So public markets in Africa need to serve us better. Digitization could to some extent help. Kenya, as Benjamin mentioned, has done a lot of work on virtual asset laws. They came into regulation with the CMA in October. But at the same time, we did a lot of work ahead of that with Seychelles to say, you have a Securities Act, a digital asset that's got an underlying value with gold or any other pool is a security. So we actually got that approved ahead of those coming in. So we shouldn't see regulations as an impediment. And obviously certain countries have also brought in carbon laws, and you can use digitization and carbon together. But actually the biggest opportunity, and I'm going to be somewhat controversial as well, and I know MICA and the MiFID regulations relatively well, but sometimes they're fundamentally flawed. And this isn't synonymous of the EU. It's a broader problem because we think in silos. So let me give you one challenge, for example, in the EU context, but it applies in the UK, it applies elsewhere, even Kenya. So if we look at crypto and those vast regulations in Kenya, I don't want to keep picking on Kenya, but I'll relate that back to Europe. It is really, really interesting because if the Binances and these other institutions come in and want to get regulated under those new laws, they have to actually get approval from the central bank. And as Benjamin mentioned, it might not necessarily be in the central bank's interest to provide that approval. The central bank sits under Treasury, and then ultimately, obviously, again, there's a level of policy alignment. But if you want to get approval to set up a digital securities exchange or a custodian, you can get that from the CMA. But now what happens, okay, let me give you a use case. So I would argue the biggest way of solving, let's say, the $4 trillion annual climate financing gap, of which 800 billion is Africa alone, is harnessing digital capital. There's a huge amount of money, whether we like stablecoins or we don't, but there's a huge amount of money on the digital asset side. Like Tether, as a stablecoin issuer, has $180 billion of reserve. So let's just round that up to 200 billion. Even 0.5% of that is $1 billion of investment. Everyone talks about KYC AML, but actually it's easier to KYC AML the source of money from a crypto perspective, and bad things happen in the traditional markets as well. You know, money moves illicitly, and good money and bad money moves in both systems. But actually, there's huge pools of capital now on the digital asset side that we've established with the right compliance can be harnessed into natural asset pools that Africa has and unlock the value of those assets and bring new investment in. That's also helping to spur traditional investment to come in at the same time, because they want that investment needs to be de-risked. It wants co-investment as well. You know, Andre doesn't invest alone. So when we combine these factors together, actually, it's leading to a step change. And everyone thinks about it might happen, but we're seeing it's already happening. And we've got sovereign governments waking up to this. I mean, not only in Morocco, but across Africa and also Latin America as well, which have huge reserves of assets. And now can access capital using private capital, public markets, and crypto capital as well. Thank you.
Thank you so much, Mr. Hirander. You mentioned the challenges, micro and macro levels, and you brought to my attention one of the challenges, I think it's a macro level, which is sustainability issues. I would like to ask you a second question. How can tech innovators integrate climate accountability and inclusion and sustainability frameworks without constraining growth or adding any excessive costs? I don't know if it's possible.
Great question, Mariam. So the question is, and it seems like a contradiction in terms, can we make sustainability sustainable? You know, we've spoken about aid going away. In many ways, that was a blessing and a curse, because it's forced both institutions at the local level within Africa, national governments to start look at a different model, because they had no other choice. We have no other choice. It was there one day and it's gone away. Now, you know, we've engaged a lot. You know, when we started this journey on carbon credits, we were really excited because we had the technology to kind of interconnect fragmented markets. Like everyone speaks about the carbon market as one market, but there are multiple registries, there are multiple exchanges. Now Kenya is launching its national registry at some stage. Other African countries are as well. And again, fragmentation and lack of interoperability exists just the same way as digital markets. So when we looked at this, we were really excited. We thought, you know, we'll do the right thing. We'll apply our technology, which was fundamentally designed to bridge between traditional finance and digital finance to carbon markets. We got really, really excited because 6 months after launching that in the middle of 2003, at the end of the year, we won the tech sprint as the best blockchain solution to scale climate finance at COP28 in UAE. And we thought, oh, great, our floodgates are going to open, everyone's going to converge in, and you know, this is great. You know, we're going to do great guns as a company. But as we engaged with buyers of credits, and everyone speaks about integrity of carbon credits. It's very difficult to measure, because how's this piece of air valuable and how's this piece of air junk? Because there's nothing tangible there. It's not even cryptographic, because you're trying to relate it to an asset that doesn't really exist. And then we realized actually it was about digital measurement, reporting, verification. And much like any commodity, everyone speaks about digitization solving the world's problems, but the digital world and the physical world, you know, in the metaverse, Miriam, you spoke about assets being sold that didn't exist. It's even more challenging in the digital world. I mean, you know, we're drinking water from this bottle, but we don't know the source of this water and where it came from. And we removed the labels for advertising purposes, but it's very difficult to trace the source or the food on our plate when we had lunch this afternoon. So you know, rather than you know, solution looking for a problem, and a problem looking, you know, being a problem that needs to be looking for a solution, we have to apply the technology that exists now. And we talk about AI and blockchain and measurement, IoT, AI, blockchain coming together. We have all the technology at our disposal to solve that source to sale provenance issue. And we did that in a way that allowed provenance on carbon markets and lowered the cost for those that are acquiring credits, but also those project developers that could bring those projects to market. But the problem was inertia. National institutions that make a lot of money and consultants that make a lot of money from status quo don't want change. I mean, some of the things that Benjamin and James mentioned when we talk about even governments that are worried about, they have capital controls because of foreign direct investment. Now, going back to answer your question, Miriam, what we concluded was carbon credits on their own are a useful tool, but not really only part of the answer, because you don't want to shy away from companies, whether it's oil companies or big tech companies that have an increasing need for AI to decarbonize as well. AI needs data centers need power. Really, we were speaking about renewable energy, but there's not enough of it. So we've gone back to kind of an increased demand for fossil fuels. In turn, data centers need servers need critical minerals, even gold, for different reasons the US administration have assigned critical mineral status with recently. And for the magnetics, it needs rare earth. So actually, you've got to create circularity between these assets. But with mining restoration, you can extract rare earth, you can generate carbon credits, but the rare earth in it is valuable. So going back to your question, the answer is combining these decarbonization activities with other kinds of output that actually genuinely create value, so that from a P&L perspective, carbon offsetting is a small proportion of the cost, and it drives money to come in because more broadly it's economic. And we're seeing this is the only way to address this problem, whether you're an airline or a big tech company or a mining company.
Thank you so much, Mr. Herbrander, for your brilliant insights. I think our session, or at least let me say our questions came to an end. I will for sure open the floor for the questions for the audience. If you have any question, kindly raise your hand and ask a question. Do you want to intervene? You have a question. Please go ahead, Naoki.
So I'm just curious to know, like, this is more so for you, Andre, but maybe everyone else on the panel can answer as well. What do you think is the next frontier for fintech? Last year, you were also on a panel like this, and you said something that payments is like a race to the bottom. And for, I'm building in Nigeria, and I hear this discourse a lot, like we have way too many fintechs in Nigeria. They're kind of like all doing the same thing. Do we need any more fintechs? But I think we do. But how do we, in your opinion, how do we diversify? And what would be the next frontier? Like, for example, like I use Glovo in Nigeria. So would like Glovo go into financial services, for example? Is that like an example of the next frontier of like fintech in Africa?
Before giving the floor to Andre, I would like to remind you all, please keep your questions concise and brief, and the answers as well.
Awesome question, Jenny. Thank you. So again, our thesis is not centric around fintech. In our opinion, no, there's no world in Africa without fintech. So that's the number one, the way we kind of extrapolate the market, and what we look for is we know fintech is going to play a major role. The way we see the opportunities, though, is, and I think it's back to what I was discussing earlier, is we see a lot of players coming in to fix this problem. We say we know how to do the payment rails the best compared to anybody else. We still believe it's a race to the bottom. We still believe that it's a commoditized service. And then the question shifts then is, and often we ask the founders this, is like, how can you make money if you're going to charge 0% fee on your transaction? And this is where the ingenuity, the creativity needs to kick in and really kind of change the models. So you could grow a fintech, you could be successful, and then you could become the super app of financial services. Just to give you, I guess, a bit of background, when I was in banking back in Canada, I don't know, 15 years ago, BCG and McKinsey came to our bank to address this specific problem. They say all your products individually are not making money, and the competitors are willing to undercut you to steal your clients. the stickiness of clients is very low when it comes to financial products. They want the best returns or the cheapest cost. And then McKinsey and BCG, I'll give them credit, I guess, they've simply said, do a lot of products and then focus on the low margins, just give it away. And what's the high margin, which is the credit card, the mortgage loans and all that stuff, focus on that and make your money on that, right? So there are models out there that exist, and I still think this model applies in the context of Africa. The problem is often the founders are too narrow in terms of what they want to accomplish, and it's hard to fight. The scalability, the unit economics are not there, and I've seen it too many times. The road from 0 to 1 to 0 to 2 is quite easy in the seed stage for fintechs in Africa. They raise $2.5 million. They have the narrative that the banks are unbanked. They have the technology stack and sometimes even use third-party stack. They use the 2 million to acquire customers, and it's like, look at us. We're growing. We have 100,000 users on board. At what cost? They're losing money. That's our money. That's VC money subsidizing this growth. How do you go from there? We know too well in Africa the funding is too scarce. I mentioned there was about $6.7 billion in fintech funding in the last 4 years. We have in growth value, we're around $10 billion in 5 years. That's nothing. We should be like in the 40 billion. We should have massive unicorns everywhere with that funding. So I think fundamentally there's a bit of a hic, at least in the earlier stage. We're seeing later stage company learning from that, right? And now they start diversifying, they're focusing on the B2B, they're focusing on several products, focusing on the high margin products. So just to answer your question short is there's no future in Africa without fintech. I think Sasha is part of the equation. I think you should be part of the equation as well, right? Embedded finance in a health tech app makes a lot of sense. How do you pay for your drugs? How are you going to manage that? And again, this is where I think these companies with embedded finance have a lot of competitive edge compared to a pure play payment, remittance, or a pure play lending.
Thank you, Andre. I will pass the mic to Professor Connor.
I am curious, why do you think we need more fintech companies? What is the gap that you see that isn't being addressed by the plethora of fintech companies already?
So for example, for me who's building a health tech company that now has embedded finance in it, I find that the existing players in the market cannot exactly address the solution for my customers. And particularly in Nigeria, about, they say 70 to 80% of Nigerians pay for healthcare out of pocket. That's due to lack of like health insurance in the market, right? And so we've been tinkering around certain things. Should we do health savings? Should we give them credit? But there aren't existing, fintechs or just fintechs that want to offer credit for health. And I understand, right? Because it's risky, and I also think that you're kind of like slapping a Band-Aid on a more pressing issue, which is you have to solve for that financial layer, which is either you risk pool funding through insurance or some other like mechanism, but to slap credit on it, I think is maybe will solve the problem in the short term, but long term will be a big problem. So I also see that in agriculture and in education, there aren't like a lot of financial services in the market that solve for our unique problems and then for our unique customer base. And so that's why I said I feel like we do need more. But to Andrew's point, to be more creative in how we think about fintech and not just from a pure like payment solution, which is, I guess, a race to the bottom. So yeah.
And the reason I ask was I'm wondering, from the investor point of view in policy, how many startup companies you see that have intellectual property as a starting point. Our observation, being in the university to tech transition ecosystem, is a lot of the tech startups are just replicating some. How many ride-hailing apps are there on the continent? And when was the last time we saw even blockchain? I mean, blockchain, the basic principles were created somewhere and then when was the last time there was a homegrown innovation that had intellectual property protection, which is going back to the policy dimension. It's very difficult to have 54 different IP policies. If a startup has to go to each country to get IP rights, it makes it very difficult to scale. So how can there be the single IP policy that enables these startups to scale? So just curious from the investor point of view, how many times startup
There's Scott and then Madame Filet. Okay, go ahead.
Yeah, I mean, real quick, on Race to the Bottom, it goes what the professor was saying is that mobile technology has evolved and made things faster and cheaper, and where Africa was doing amazing things with text messaging for mobile health, mobile payments, we've all moved beyond that. The phones have all moved beyond that. And so we have the same problem in the US. And if you're going to try and bootstrap something together, going back to what the professor said around IP, we have everybody working 4 or 5 different jobs in the US. And how do you actually do what we would call portable benefits? My benefits from my one job to my benefits from the other. I'm giving $1 billion idea away here. The reason why I can say that is because nobody's figured out all the regulations, the policies. Are you competing with Obamacare? Can you do a health savings account? Are you convinced that if you work for Uber and you work for DoorDash and you work for 4 others that they're even going to agree to this? So there are problems that need to be solved, but text message became a commodity business 10 years ago. I got out of text message when it became a commodity. Mobile apps have become a commodity. Rideshare has become a commodity. So now, if you can solve these other things, but these other things are really hard to solve.
Thank you. I will try in English if you don't have the. But when you talk about the IP, I think it's not a point already, because if we are discussing here about sovereignty, interoperability, and kind of things like this, I think some fintech or each company could build here solution on open source assets. And what will work is the product and the level of services. And the comparison also on the usage of the population, the comparison of the regulation in one place, because all the regulations are not the same everywhere. So I'm not sure that we need to have IP everywhere. IP is very complicated to manage. And even you have IP, for example, if you have an IP in Europe or in France, for example, if you move 3 lines in the code, you don't have any IP. So we don't have the same point of view in the US on what is an IP or in the Europe. So I'm not sure that it's a real point. But what could be a point to have some fintech? I agree with you that only have payment, because payment was the first level of development of fintech. It was payment, and after it was a kind of peer-to-peer financing system for project and company. And now perhaps we will see emerging other fintech in other sectors. For example, in the asset management and the CIB, we saw that there is some kind of fintech that are emerging here. They have some of them who are working on AI agent and permit to asset manager to be more efficient, for example. We saw a lot of them, but now with what happened of what we said in Europe, omnibus regulation on ESG, it's more difficult, but we have more fintech on ESG part or Well, finance durable in English, I don't know how you said, green finance, sustainable finance. So there is some area there, I think. It's not killed, but, and we talk a little about regulation. A fintech is here when there is a gap in a regulation. Every innovation is here when there is a gap in an innovation. So I'm not sure that we cover all the gaps with all the regulation now. I think there is some perspective here.
Can I just jump in? Sorry, quickly. Just on reference to global. I mean, it's an absolutely fantastic question. We're always thinking about your question every day in certain markets. If we talk about fintech particularly, obviously, I've got an app which has 3 different clients, all with transactional operations, finance. We have the courier, who we pay every week. We have the store restaurant, who sells online through us. Often we're his only mechanism or her mechanism to sell online. And of course, we have the consumer. And unfortunately, still in Africa, it's still a cash-based business in many of our markets, where a large percentage of our transactions are. So it's a huge barrier. Obviously, it creates a lot of inefficiencies. But to quickly answer the question, would global go into finance? Well, I'd love to, but I would probably only go into finance if we were fixing something, or we had a superior product that actually would make a difference and make our customers not just using global, but actually take it outside of that. And that casuistic doesn't exactly exist in every single African country. I think some are much ahead on fintech solutions versus others. But yeah, it's a massive opportunity to get into other categories, especially when you have a large user base. Thanks. I have to actually leave. I had a 5:30, so thanks.
Yeah, we're actually concluding. But thank you so much, Sasha, for joining.
Sorry.
We know that your schedule is already full. Thank you so much for joining us for all the perspective. Thank you. I will open the floor for the audience this time. If you have a question, kindly raise your hand. We can pass a mic. We can get you a mic. Okay. Yeah. Please keep it concise and brief and address it to the panelists you want to refer to.
Okay, thank you. My name is Bilal Marbouh, a tech entrepreneur. And thank you for this brilliant conversation. And my question is to Mr. James. You mentioned Africa can finance its future. So any realistic ideas can help that. And also, we need more Benyamins in Africa. And also, Mr. Hernander, you mentioned so many challenges. But in Africa, at least we need a conversation like this. So we don't speak about it. So that's the minimum we're asking about. Because you mentioned the elephant, but we don't know how this elephant look. So we bring it to the table and we discuss it and we can fix it. That's the minimum we're asking for before moving to the next level. Thank you.
Yeah, I keep coming back to a basic theme that, again, Africa is abundant in capacity. We just have to find the right mechanisms to unlock it. We've spent 3 decades thinking about that. It requires rewiring principles of money. I mean, if you get people in a room and you say, who in this room has achieved their full potential at this point in their life? No one puts their hand up. And then you go around the table and ask everybody why. And it's almost always a constraint of capital to do the things that they have in their mind that they want to achieve in their life. And yet, the world is completely abundant in capital. There is more capital flushed out of the world than we've ever seen. If you look at climate, we all know it's a $4 trillion a year shortfall to develop the amount of renewable energy infrastructure that's going to be required for us to stay under 2-degree temperature rise. However, and we have enormous trillions of dollars sitting out there that the most powerful people in the world, Bloomberg, Mark Carney, and a whole plethora of others, created something called GFANZ and went and said, oh, we're going to go and get the 121 trillion to start investing and put that 4 trillion a year in. The money didn't come. Why? Because the fundamental problem is money. The money is too busy in its new existence of making money from money. And governments, unfortunately, will never solve this problem. It's just not going to happen. Governments all act in self-interest. They don't act for the greater good. We are much more likely to have a success in making that happen with bringing together true PPP, not just, yes, governments have to have a role, no question. And governments from a regulatory standpoint are a disaster. I mean, they do what they can, but the regulators are always chasing innovation, right? They don't pre-regulate innovation. It comes after when they finally realize there's a problem. And so governments, almost a private, well, what we believe in is a private sector-led approach, where you bring private stakeholders together and they become key underpinners of the economics of money. And so you create a structure around unlocking real economy capacity as the Fort Knox. And by doing that, so if you bring it to a simple basis, like even an individual, look at what your capacity is. Think about other innovative ways to utilize that capacity, whether it's in a small business. How could you trade it? Is there someone you could trade it with that would unlock value at really the individual, the small business, and the bigger corporate and the government level? And you're seeing it's happening. I mean, China's doing it extremely well. China's created something called the Belt and Road Initiative. The Belt and Road Initiative is just China exporting its capacity and taking back payments in things that people have. Not money, but assets. So, you know, you can be doing that on your own. I say the monetary system, the money's not coming to Africa. Not without a lot of difficult terms and conditions. You know, you hear it over and over again. Oh, the risk adjusted returns aren't there. Well, yeah. So that money that didn't come into climate is not coming to Africa. And Africa doesn't need it. Africa has so much capacity. It just needs the right architecture, system architecture, to unlock it as a new form of credit.
James, just a quick question clarifying. Do you see that future as being centralized or decentralized?
Well, there's a great mentor I mentioned earlier, D. Hawk. If you ever have a chance, take a look at his book. It's called The Chaotic Age. $16 trillion payments company. His basic principle, one of his key principles, he said to me, you have to do this, is all relevant and affected parties, none more dominant than any other in matters of governance. Okay? All relevant and affected parties. So is that decentralized or is that centralized? It sounds quite decentralized, right? But how do you do it? So we spent 10 years trying to figure out how to do it. We figured out a path to it, but it is an enormous effort. But so it's a combination. I think it's a hybrid. Centralized and decentralized. Is what you, if you say, what do, you know, there's a study by Edelman. It's a fantastic study. It's a study of trust for 50 years. And over 50 years, trust has done this for governments. It's fallen. Over 50 years, trust in biggest multinational corporates has risen. People trust Nike more than they do the government of France.
It depends on the countries. For example, in the Nordic countries, it's going up exponentially.
I don't know if it's going up exponentially. In many other countries, but if you can get that report, it's quite good. But generally, see the problem again, countries act in self-interest. It's worse. They act in political leader interest. The countries that are exceptions to this are ruler countries. Countries that are governed by a ruler where there's sustainability and there's a longer term interest. But countries where there's a political election or a coup, forget it. I mean, it's a disaster.
And
Thank you. make sure first that the audience, do you have any question, the audience, so that we can keep the discussion going until we conclude the session? No questions? Okay, we go. Scott.
Real quick, I know it's really, really nice to James on the left on solving a lot of these problems, but self-regulation from an industry that came out of gangsters and thieves is not necessarily the best idea. Self-regulation didn't work so well in the U.S. model of cryptocurrency, crypto wallets, etc. So I would caution Africa as they're moving and jumping and going further ahead than just looking at letting the original early adopters that were solving, as I think the professor said, problems that the government couldn't, or Nadia said it around, they found a little loophole in the government and did something with it. Well, these may not be the best people to do self-regulation.
Thank you. Who's next?
Regulation.
Okay. Okay. For me, maybe if I could just share a word with regard to what Nokwe asked about with regard to financial inclusion. I'm thinking, as Nadia says, that we've focused on payments, for years, and in my view, most research, data when we talk about financial inclusion, we really look at who has a bank account. So in my view, this has made the entire ecosystem of when we are trying to solve the problem of low financial inclusion or low access to finance. So we try to make more people who have money under their mattresses get that money into the bank. But in my view, I think financial inclusion is a compound word, and if it cannot be defined as such, even in our research literature, we continue to solve the wrong problem. In my view, financial inclusion should include access to finance, which is should be a key aspect of financial inclusion. Otherwise, we continue to build solutions in the name of fintech to convince more people to bring their money in Congo, in DRC, in Kenya, to bring out their money and put it in the bank. Then what? I want money so that I go and buy tomatoes, I go and buy some fruits. What's the difference if I put it into the bank or into some mobile money app? There is this product in Kenya known as Shamba Records. Shamba Records, what they do is really trying to help smallholder farmers to be able to have proper records of their financial transactions and proper records of their produce, so that they have some records to access finance. So the question I asked with regard to even the fintechs, the small fintech solutions, are they seeking to help these users to also access finance and access insurance? These are terms that should include the compound term or the compound phrase, financial inclusion. Thank you.
Oh my God, James is.
On this, because we've done quite a big study on this issue. So small plot farmers is a great example of unused capacity. Okay, so if you're a small plot farmer, you have a piece of land this big, right? And you are getting out of that land a yield. That yield might be 20% of what that land is available to possibly produce. The only reason for that is you have no money. You can't buy the seed, you can't buy the equipment, you can't buy the fertilizer, you can't buy the irrigation equipment. So you're only getting 20% yield. All right. Now, if you could finance this operation, they might get 80% yield. Well, if they were to get 80% yield, that capacity output, it's forward, it's future output, but it's almost certain that they would get that. And you can even assure that. So therefore, there's real capacity. Well, if you can, remember, capacity equals money. If you can now unlock a form of credit based on that capacity, you change farming in Africa.
Wow.
Isn't that a metaphor for fragmentation? I mean, should that small farmer be in that small farmer sector? Why not mechanize agriculture and have that farmer do something else? I mean, again, we're going back to the metaphor of fragmentation as a key challenge across the continent. Why not move towards what many other regions have done of mass agriculture to get economies of scale, and then have that farmer do something else? Is it realistic that this farmer, even if they get capacity, is going to compete with some mass-produced mechanized farming?
With quality, they can do it. Sorry, but
Compared to mass mechanized.
yes.
The same principle applies to the mass facility. The mass farmer, the large farming facilities are also having difficulties in financing seed growth, irrigation, new equipment. So the same principle of what I said on a small plot farmer basis applies on larger scale. But I'm just saying, I can't remember the data, but the data point on small plot farmers, if you can uplift you're talking about financial inclusion, if you can uplift the capacity output and therefore the revenue of that small plot farmer by giving them an ability to finance based on their forward capacity at zero interest, I mean, that is life-changing for them.
And something, sorry, I want to react on many things, and there is a link between all of that. I think that if we can have some microcredit in Africa, it could be really interesting at different points. I think more than 10 years ago, I was working at a jury. I was in a jury in AXA. It's an insurance, a huge insurance in France and Europe. And I don't know about the data, but the level of saving in Africa is almost the same than in OECD. Okay? You don't have the same revenue, but the level is almost the same. So if some of the people who have this saving accept to finance the community, and I will use that word with, comment dire, de manière... I will use it really en conscience, consciously. We can change the financing system or small financing system in a community. You talk about trust. There is in French only one word, confiance. In English, there is two words, trust and confidence. And we work on that. And I agree that in the north of Europe, the level of trust is better than in the south. And it's why we can have identity system in Sweden, for example, or in Estonia, but not in Spain and not in France and not in Italy, because we don't want that the government know everything that we are doing, even linked with our money. But there is also now some lack of confidence. And the trust is for the government, the company, the bank, and the confidence is on your side. This movement make population move to individuality to community. Community is very dangerous. If I fight with Mr., I will don't do it. We can die together. But if we fight community under community, it's more dangerous. And the world is changing, it's moving to individuality to community. But if you use the power of community, that community help each other, it could be something very good. And I think that in Africa and in other regions in the world, we know before how to work in community. We know how to help together. I think sorry about that, but I think sometimes I don't have the good words, but I think we don't, or the political good ones. I think we don't care to be very huge or big. We just need to be resilient. And if we have an economic system or a financial system that make people resilient, it could be something really interesting. And it's this kind of finance that we can develop here. It will have the big finance around us, but we need to develop an ecosystem of SMEs or very small, not SMEs, but TPE, little small SMEs or little small farmers that will work concretely. And technology could help. I know someone here in Morocco who developed a company help farmers with AI, and they have low charge in the insurance because they know how to manage the quality of the water, the quality of what plant they put there, because there is less water, less sun, less blah blah blah, and there is solution, I think, but this solution needs to make people work together and work in small area.
Very quick point, and it'll factor this in. I mean, going back to what Professor Conrad said, the important thing is choice. So these entrepreneurs, I mean, if they want to be smallholder farmers, they should be allowed to be. Now, there's just some stats in support of what James said. So, I mean, where we started out looking at this area, I mean, wasn't carbon credits, it was actually electronic warehouse receipts in Malawi, where we saw that we were astounded that even with some form of security, the banks were lending to smallholder farmers for inputs, pesticides, fertilizers, and seeds at about 30% interest rate, and that's with security. And we realized a lot of what we built as a digital platform could bring in some of the micro lending firms and compete for the cost of credit and lower that interest rate. So we managed to run a pilot with 48,000 farmers, get that cost of credit down by 2/3. You know, I mean, there was still further to go, but actually, the end result of that was an increase in income of 35%, which we then did a study on everything from women's empowerment to children's nutrition, given your earlier panel, Miriam, that you were mentioning, you know, that you were at, and there was a drastic impact in terms of those related areas. So it all goes back to the means of finance and the cost of finance.
Nadia's comment, you know, community. I said earlier, DHawk, the founder of Visa, he said, it's all about creating community. If you can exchange value between parties, and it's still happening in Africa, there's still communities. When I started looking at this world of barter, one of the things I was fascinated by is in Africa, there's still co-ops getting together. Farmers are actually swapping what each other needs. It's fascinating, you know.
Of value.
There's a fellow, I don't know his name, you may know, but he's a fellow that has created a Pan-African community of small plot and farmers generally, but he's created tools to help them. He's got, you know, a standard phone, like a lot of them don't even have phones, and he also has like drones that come in and they'll kind of do surveys of their land and he's giving services on a community broad base to help these small plot farmers. I mean, it's a fantastic community.
Please, allow me to respond to Taka. Taka asked Professor Taka asked a good question to James, and I want to weigh in with regard to, can we just mechanize these farms? Yeah, and yeah, the way it's done in Europe, in America, you know. In my view, that would be copy pasting the policy or the culture, or the way it's done in Europe and in Africa. In my view, we have a lot of smallholder farmers in Africa. The way farming is seen in Africa, it is a lot of the time subsistence. Yeah, it's a lot of the time a backyard farm, yeah, and even the way land is seen, land is inherited, the way it is owned, it becomes very difficult to mechanize this. And the Kenyan president is really trying, yeah, first by changing land laws, yeah. And one of the things that they're saying is that if your land is lying fallow, you've not been using this land, instead of building your house there so that, you have this 2-acre home, you just need to own a home, an apartment, and give out this land to farming. But you see, the culture across Africa, one, we have a ballooning unemployment rate, yeah, a lot of youth population, yeah. So meaning mechanizing also removes this out of our hands in terms of becoming part of that creation of employment. And then second, with regard to families, with regard to households, farming is much more subsistence, yeah. This small family of 3, they just want to ensure that they have food every day. Yeah, and they have some little money out of this farming that they can be able to use to buy extra. So mechanization will be very complex in Africa. It can be done in a hybrid way for some major tracts of land, but subsistence farming is here to stay. And these subsistence farmers are the ones that need this access to microcredit so that they are more productive and they are able to really pay school fees get some little money to pay school fees for their children. Thank you.
And this will be the last intervention.
And so thanks for the very interesting discussions and debates, but maybe it may play out differently from the West. I guess the point was that economies of scale, and I'll give an example. So I'm originally from Sierra Leone, and there's a very traditional attire that has been made in the same way for centuries, and no one ever thought that. And same kind of families make it. No one ever thought that the Chinese would be able to mass produce it. And so fast forward today, there are factories in China who are making very similar Sierra Leonean attire at a much lower price point, and then the loyalty of your customer is really tested because now people are buying the made in China fabric. So are we going to wait for something similar to happen to smallholder farmers? If our smallholder farmers were producing enough, why are we importing so much food then on the continent? So there seems to be some mismatch.
Well, trust me, I really feel so bad because I'm not here just as a moderator, but as a timekeeper as well. So big applause, everyone. Thank you so much to my dear distinguished panelists for this amazing and engaging session. It was really an honor to listen to all your insights, and you really enlightened us on many, many aspects. And especially for non-financial people like myself, it was a brilliant session. Too many perspectives, different perspectives, brilliant, sometimes sneaky perspectives. Oh my God, I love it. Thank you so much. And we can continue the discussion outside if you will.
Just one last thing, please, if you can join for the photo group. Thank you.